All right, welcome to this new spring enrollment video where I want to go over resistance. In the previous educational video, we also went over resistance, but now I want to go over resistance in the form of determining high probability versus low probability conditions. Now, first, a quick reminder, quick refresher right here of what we went over in the previous video. How far can we retrace? So resistance determines the retracement. What is that resistance then? That resistance is opposing PD rays. What is those opposing PD rays? Well, if we have a bullish trend and we have discount arrays holding, then the opposing PD rays are premium arrays. So premium arrays are in that case the resistance. So resistance is always viewed on the same time frame or a time frame above us. So for example, if we take a look at the 15-minute time frame and we are looking at a 15-minute discount array to trade off of, then 1 minute premium arrays are not resistance because it's not on the same time frame as that 15-minute discount array and it's not above us. That's quite important to understand as well, how we filter out the right resistance. Now, with that understanding, we also went over a big topic, which was the pushing battle. And the pushing battle right here was simply said, if we have bullish and bearish price action, a different pushing hands right there, that leads to an overall determination of how far we can actually retrace. So what do I mean by that? Well, if we have a strong green hand, which is a strong discount array, pushes price higher, and we have a weak red hand, so a smaller red hand right there, and that is a premium array, then that premium array will likely not push price very far below to then continue higher of already the first discount array in itself, because the pushing hand, the bullish pushing hand, is stronger than the bearish pushing hand. Where if we have two big hands right there, a big red hand, a big green hand as well, that leads to a further retracement right there to then continue higher. So we have strong resistance and we have weak resistance as well. Now you can imagine if we take the right example on the right side and we think away. So we remove the two up candles that we have right there. Then you can imagine if both hands are very strong and the pushing battle creates balance, where both hands are that strong that we are not pushing higher, we are not pushing lower, that creates 50-50 price action. That overall now creates consolidation price action, rangy price action. So if both hands are really strong right there, we are not going anywhere. And that's exactly what we also need to dive into in this video. So right here, resistance creates low probability versus high probability. LP is low probability again, and HP is high probability. Now, why is this so important to understand is because we need to determine overall what our low probability conditions are, what our high probability conditions are. Simply said, because if we are trading in low probability conditions and afterwards we are trading in high probability conditions, oftentimes traders can find winners. As in, I think everyone has experienced some kind of win, right? And most likely that is because you are trading in high probability conditions, that those high probability conditions for your trading plan right there. But where most traders go wrong is then they take those profits that they made in high probability conditions, and then they use those profits to try to make more profits in low probability conditions. So meaning they move from one high probability condition towards the next one, but whilst they move from the previous high probability condition towards the next one, they also encounter low probability conditions where they will blow all their profits before they even get a chance to trade high probability conditions again. And that is extremely important to understand as well, because it's not necessarily about winning. Of course, it's about winning. Of course, you need to win in order to be profitable. Of course. But where most traders go wrong is trying to trade low probability conditions and not preserving capital, not saving that capital for a better day, for a better week, for a better month even. And that is extremely important. Most people are too impatient to actually wait for new high probability conditions. And that is extremely important. That is the key. So first things first, we have LP, low probability conditions, very simply avoid. What exactly are the different conditions here? Exactly what we're going to go over in the next few slides. Then we have 50-50. So that's in between the extremely low probability and in between the extremely high probability, where LP and HP, they are just two extremes. Now, 50-50 right here is what it means essentially is not too convinced of higher prices or lower prices. So a little bit in between, 50-50, hence the name 50-50. Now, that is also what you want to avoid. 50-50 is also low probability conditions. There is no high probability condition besides actually high probability conditions. So 50-50, even 90-10, 80-20, 60-40, whatever it may be, everything below 100 is simply said low probability conditions, where we can view this as just 0-0 extremely low probability conditions, where one side of the scale is either bullish or bearish. Then we have 50-50, so we have 50 bullish, 50 bearish, low probability. Then we have 100-0, which is 100% bullish or 100% bearish, one side. That is exactly high probability conditions. So that is also what we want to aim for. We don't want to trade anything else besides high probability conditions. And when we trade that, we will also be extremely profitable. So high probability conditions right here, get involved whatever it takes. And what do I mean by that actually before we move on? Oftentimes I mention that if the draw on liquidity is so stupidly clear, that's how it should be. A draw on liquidity should be so stupidly clear that we are going to move there. That's exactly when you want to get involved, no matter what it takes. Even if the entry is ugly, even if the risk management is a little bit off, even if you need to rush to your PC right now to get involved, you need to get involved. Now, of course, I'm over exaggerating a little bit as well. We of course need to determine our risk management properly, etc. But the conclusion or the point that I'm trying to get across is that oftentimes people will try to trade the low probability conditions and then will get so messed up or so destroyed by the low probability conditions that they do not even try to trade the high probability conditions anymore. So then the inverse happens where they're trading low probability conditions, they avoid the high probability conditions and then try to trade the low probability conditions again. Where we want to do the opposite, high probability conditions right there, and then we want to wait. And we have no idea how long we are going to wait until we see high probability conditions again. So get involved whatever it takes, because it might just be your last opportunity to trade high probability conditions. That's an exaggeration, of course. We will see high probability conditions again. But if you want to trade and you want to make money from it, and you are trading high probability conditions and there's a chance to trade high probability conditions, then we should take advantage of that. We should, when it rains, it pours, essentially. Meaning that if we have high probability conditions, we want to make a good amount of money that we are set to wait for a couple of months, for maybe a couple of years, or even just weeks, right? So we can sit out low probability conditions, where 1 week might be very nice, and then the next week is just not that nice price action. So we want to make sure in that nice price action week that we make enough so we can actually afford to sit out in the low probability conditions. That will make it a lot easier to also stay on the sidelines, actually. That is very important. So that's why I say get involved whatever it takes. Of course, take it with a little bit of grain of salt. We still need to do the right things, but it's very important to understand that. So what then is low probability conditions? That's the first step we need to go over. Low probability conditions. The first thing is trapped order flow. So trapped order flow, what is that? Trapped between a premium array and a discount array. Remember the pushing battle that I just mentioned, where if we have a very strong bullish hand, a very strong bearish hand, that creates overall balance. That we don't go anywhere right there because they're both holding it in balance, because both hands are just as strong as the other hand. So that is very important. So this is the first area where order flow can switch. So what does this look like? Right here, we are on the E-mini S&P 500. And if we take a look at this daily fair value gap right there, that is where we can potentially continue higher from. Now, If we want to continue higher from, what will we actually see on the lower time frame? On the lower time frame right here, whilst we are coming into that daily fair value gap, of course, we create some kind of bearish price action right there coming into that. So in order for us to actually be bullish at this moment in time, we now need to create, again, 15-minute bullish order flow. So what happens here? There's a conflict of interest, as I like to call it. And what I mean by that is we have this daily fair value gap, which we can continue higher from, but we also have this 15-minute premium rate, where if we now want to continue lower, then where will we continue lower from? That 15-minute fair value gap right there. This is what creates 50-50 price action. So yesterday during the live session, actually, we mentioned this, that this is potentially the worst place you could get involved right now. And what I mean by that is, if we take it even a little bit further and we go into the lower time frame, we even go into the 5-minute, or we even go into the 1-minute right there, then what we see is we also have this 1-minute fair value gap high right there. So now there's a lot of conflict, because if we want to continue lower, we will continue lower off of this 15-minute fair value gap that we have right there. If we want to continue higher, then we will continue higher off of this daily fair value gap sitting right there. If we also want to continue higher, then we will continue higher off this 1-minute fair value gap right there. So there's now a lot of conflict. There is a strong bearish hand, there's a strong bullish hand, which overall leads to 50-50 price action right there. So why is this important to understand, and what are different factors as well that we need to take into account? The reason this is extremely important to understand is because we do not want to trade 50-50 price action. We do not want to trade price action if it's not actually moving anywhere. Because if it's not moving anywhere, then it will also not hit our take profit. It will most likely hit our stop loss before it hits our take profit. Because if we're not making a significant move and we have, let's say, a 1 to 2 RR right there, then what is closer? Our stop loss is always going to be closer than our take profit if we're not actually making a significant move. So then the logical thing right there is that our stop loss is higher probability to be hit than our take profit because we're not actually moving. So that is extremely important to understand why we want to avoid this trapped order flow right there. Now, you might also say, but this daily fair value gap right there is stronger than that 15-minute fair value gap. And that is true. That is 100% true. But the thing is right there that 15-minute order flow still needs to switch. So as long as 15-minute order flow does not switch, even though we have a stronger fair value gap in the form of that daily fair value gap right there, then nothing will actually happen. We will still have that 15-minute trapped order flow right there and 15-minute bearish order flow to continue lower. Now, there's also another thing we need to go over is why that 15-minute fair value gap? Why not the 1 hour? Why not the 4 hour? Why not the 5 minutes? Ideally, what you want to do is when we come into a daily fair value gap like this, you want to work your way down the time frames to go into the 4 hour to find a fair value gap that might be on the 4 hour fair value gap right there that pushes into the daily fair value gap right there. Now, at this moment in time, you might think, well, we have this 4 hour fair value gap there, right? Yes, but at the moment that we create that 50-50 price action on the 15-minute, we did not have the 4 hour fair value gap just yet. So this candle right there, the up candle that you're seeing right there, was still forming, was still in formation. So right here, we go down another time frame, where at this moment in time, we also have that 1 hour fair value gap, right? Yes, but at that moment in time, once we have that 1 hour fair value gap right there, this was not created just yet before that 15-minute fair value gap. So again, it's the same exact thing on the 4 hour right there, where eventually, if we do create that whilst coming into that daily fair value gap, we can use that instead as well, where here it was the 15-minute right there. Now, I also want to mention that it's either 15-minute or above minimum right there. And the reason for that is because the PD arrays, remember the PD arrays time frames that we actually use, when we want to trade off of a PD array, we are always using a 15-minute or above. So not a 5-minute, not a 1 minute. Actually, PD arrays that we are looking to confirm is 15-minute and above. So that is also what we are looking at right there. Now, looking at a US dollar CHF right here, I want to quickly go over this example as well. We have the 4-hour right there, 4-hour value gap, which we can continue higher off of. We also have that order block sitting right there. Now, if we want to continue higher off of that, again, what needs to happen most likely? Because we have been continuing lower right there for a little while on the lower time frame. So there needs to be some kind of order flow transition to, again, be bullish. So what does that look like? That looks like the following. On the 15-minute right here, we have these 15-minute fair value gaps right there, pushing price into, again, that 4-hour value gap right here. And also we have this 15-minute fair value gap right there, and even a little bit lower right there, that 15-minute fair value gap. So what we will see is when we transition from bearish order flow to then try to transition to bullish order flow right there, then again, we will see trapped order flow, where price is just in the transition from switching to one order flow side right there, which leads overall to consolidating price action, rangy price action. We might get weird sweeps on one side of the market. And to visually make this clear as well, if we go into the lower time frame right there, what we'll see is we get weird sweeps like that before we continue lower. We then see right here on both sides of the market, we see weird sweeps before we then actually make a significant move. And that is again because we have that transition of order flow right there. It's transitioning. And that is very key to understand, because that is where we ideally want to wait a little bit until we take one side of the market very clearly. And how we can spot that is eventually what we're also going to go over. So the next low probability condition right there is simply said resistance. The more resistance, the lower probability. Buying into resistance is low probability. So what does that look like? If we take a look at GBP US dollar right here, we can potentially continue higher off of that daily fair value gap right there. And we also have that fair value area, which we even talked about in previous videos. Now, right here, if we then go into the 4-hour time frame right here, we can see as well, if the 4-hour wants to continue higher, then we are running into quite some resistance, right? That order block, this 4-hour fair value gap sitting right there, this fair value gap sitting right there as well. Then even we have this breaker sitting right there before we actually want to continue lower. Sorry, the mitigation block sitting right there before we want to continue higher, continue lower. So we have quite some resistance, and at every area right there, it's extremely important to understand as well that if we are now looking at a certain setup on the 15-minute, on the 1-hour, etc., then we do not want to buy into that resistance. So the first thing is having a lot of resistance on the side that actually comes into the fair value gap or the PD rate that we want to continue higher off of right there. That creates the understanding as well that is already a little bit suspicious, but that's not the end of the world, because there will likely always be some kind of resistance. But then what we need to be very careful of is that we are not buying into the resistance. So what does that mean? Well, right here, if we take a look at this fair value gap and we remove all the other lines right there. And on the 15-minute, we might see a 15-minute fair value gap right there, which we can potentially continue higher off of. We place our stop loss, I don't know where, let's say we place our stop loss right there, just a random example. Then once we run into their resistance right there, we do not want to immediately look for a buy right there, because now we are buying into resistance. And again, you can see what then happens at that resistance level. We have low probability conditions because we consolidate right there. So that again is extremely important to understand, that we want to buy before we reach the next resistance. So what does that mean? Right here, we are moving into that next resistance zone. So we have overcame previous resistance, etc. Remember what I talked about in the previous video, no man's land. No man's land is where price will be very nice. It will be high probability because we're not running into resistance. That is where price is allowed to run. So right here, the next resistance is this fair value gap right there. So if we understand that, perfect. then what can we do? We can look to buy here, but we buy until we reach that resistance zone right there. So right here, I want to go over ES as well, an example that we used before to visually show you very clearly what I mean with that resistance. This 4-hour value gap right there is where we even discussed before this, that we can continue higher off of that. Perfect. So coming into that, and when we want to confirm that, for example, on a 5-minute time frame, on potentially even after that, the 1-minute time frame, we are running into resistance areas. So what are those resistance areas? Let's count them all right here. On the 5-minute, we have this 5 minutes fair value gap right there. Then afterwards, we have this order block right there. And that is the resistance before we actually only have highs left right there. Now, how do we want to go about this? Well, right here, this first area is where we have 4-hour value gap right there, which could push price higher. This is where price could push lower if it wants to still continue lower. So there right there is 50-50. That is the trapped order flow part right there. After that, what do we see? We have resistance in the form of that order block right there, which we are also running into. So let's say we were at that moment in time, we were trading the 1-minute time frame right here. Do we want to buy right away? In hindsight, this is a perfect entry, but in real time, that entry in itself will not play out a lot of times. So right here, if we want to take this entry right there, then yes, that's a good entry depending on where your stop loss is. Because right here, this again is resistance. So ideally you want to wait. You want to wait until the resistance is over. And then right there, we get a new fair value gap higher. And that is exactly where we can look for our entry. And afterwards, it's very easy going because we don't have strong resistance anymore. The only thing left is those highs, which we can run as well. And that again is extremely important to understand. All right, we understand those resistance parts right there, which also the resistance leads to that trapped order flow, then resistance in itself, where we ideally want to look to buy. We want to be careful when we do run into some kind of resistance. That is very important. Now, next thing is seek and destroy. Seek and destroy is a crucial part because if we have seek and destroy, there is no order flow and it's just extremely low probability to get involved as well. Seek and destroy defined is fair value gaps not holding on both sides of the market. And let's define that holding part then. Fair value gaps not holding means holding is when we have a fair value gap, we trade into that fair value gap and we create a new fair value gap off of that. So when we have a bullish fair value gap, we trade into that bullish fair value gap, and off of that bullish fair value gap, we create a new bullish fair value gap, which would also be known as just order flow. If that does not happen, then we can potentially disrespect the fair value gap. That's no big deal. But what happens after is important. And let me take you through it. Here on crude oil on the 4-hour time frame, we can see it very, very clearly. So what do we actually see right here? We have one fair value gap going higher right there. That fair value gap does not hold. So it does not create a new fair value gap higher off of that. All right, that's no big deal, right? Because if we're not bullish, we can just simply be bearish. So that's no big deal. So right here, we then create this bearish fair value gap right there, that, and even a little bit lower right there, using this one for the example, where we sting into and we do not create a new 4-hour bearish fair value gap lower off of that. So what does this mean? We had a bullish fair value gap, which did not hold. We had a bearish fair value gap, which also did not hold. That indicates right there that both sides of the market are actually not holding right there. So both sides of the market, fair value gaps are not holding. They are not creating new fair value gaps higher and lower. So as soon as that happens and we fail to create a fair value gap lower in this area right there, that indicates that we now have low probability conditions. So every fair value gap after that is low probability, unless we trade into a clear higher time from discount rate again and we confirm clear order flow again. So for example, right here, we have this discount rate that we sweep right there in the form of that swing low to then again confirm order flow to then continue higher. That is perfectly fine. But As long as we don't do that and we don't trade into a higher time frame discount rate, so above the 4 hour right there, we will stay in those seek and destroy conditions. So every fair value gap that you see right there on the 4 hour, on the 1 hour, is simply said low probability to actually trade off of. Avoiding these conditions right here will already do a lot for your trading. Again, avoid that trapped order flow right there. That's extremely important. Recognize when it is trapped order flow as well. Wait a little bit. Then the resistance as well. We will always have resistance, right? There will always be resistance, but the resistance is important to understand. First of all, how far we can retrace right there, and then where we actually want to be buying as well or selling. That's extremely important. Seek and destroy as well, because that will filter out the fair value gaps that you absolutely do not want to use. Now, moving on from low probability conditions, we also need to go over, of course, 50-50 conditions. 50-50 conditions is, again, in between that low probability and high probability right there. 50-50 oftentimes is when we have no FVGs, meaning no FVGs are being created. That leads to an understanding we don't have bullish intention, we don't have bearish intention, it's just 50-50. It can do whatever it wants at that moment in time. So also we want to avoid that. Then a next 50-50 argument that, or 50-50 condition that you will hear me mention a lot of times is arguments. So no clear argument winner. That also leads to, again, 50-50 price action, which leads to low probability conditions. So let's go over them both right there. Here we are on Euro GBP, and eventually when we start doing a top-down analysis, you will see me go over this a lot. You will see me invalidate certain pairs as well a lot. And that often has a reason right here. If we take a look at the monthly time frame first on Euro GBP right here. There's a reason I picked this one, because you can probably already tell, when is the last time we actually created a fair value gap right here? That was, the expansion phase was in the 1st of May 2023. That is insane. That is a long time ago for it to create a monthly value gap. So that is where we now already are a little bit suspicious. But let's say the weekly is very clean right there and the weekly is beautiful and we can still trade that. Well, when is the last time right here that a weekly fair value gap was actually created? It was beginning of the year, beginning of this year right there. All right, that again is already again suspicious. Or sorry, am I missing one? A small one sitting right there. 15th of January. Okay, still the beginning of the year, the expansion phase right there. But still, we can see no fair value gaps, no new fair value gaps being created. And on the daily, what are we seeing? We are seeing some small fair value gaps right there being created, where the last one was actually this week. Before that, we had last month. Before that, we had the beginning right there, or 14th of February as well. Before that, let's see, we had there the 3rd of January. So also the beginning of the year. So you can probably tell, again, the point I'm trying to get across is, if we don't have fair value gaps to work with, we have no order flow to work with. If there's no fair value gaps to work with, then there's no direction to actually work with. So that also leads to the understanding right here that even if we do create a fair value gap higher or lower, that's not necessarily a fair value gap you now all of a sudden want to trade off of, because we have no established order flow. Fair value gaps are not holding. Remember, seek and short conditions. So everything right there points into the same direction, which is low probability. So at this moment in time, we have that daily fair value gap higher right there. Is that a daily fair value gap higher that I want to trade off of? Well, looking at the previous history of Euro GBP, it doesn't have a good history of even creating new fair value gaps. So in order for that fair value gap to hold right there, it would have to create now a new fair value gap higher. So in order for us to have a great trade, that daily time frame would want to create a new daily fair value gap higher. Is that very high probability at this moment in time? No, just simply looking at the overall resume of what Euro GBP has been doing. Euro GBP right there is known for, in recent times, to not create fair value gaps. Perfect. So that means something. That means it is low probability. So the way I also like to use an analogy, and that is the loyalty test. where if price shows you that fair value gaps are not holding right there, then will you trust after that? If it shows a fair value, you might trust it, right? You might trust, all right, you show me a fair value gap, perfect, I might trust you. And then afterwards, if fair value gaps are clearly not holding, and it's showing you that, it's showing that fair value gaps are not holding, can you trust that? Can you trust that? No. It's very important to understand that as well, that those fair value gaps are not holding, and it's known for almost not holding. It's like being together with someone that is known for cheating. It's a loyalty test. Can you trust that person? Well, your resume right there says something else. So I'm not too sure, right? So that is very important as well to understand the loyalty test that we use for those fair value gaps. Where the highest probability condition is, of course, when we can visually see fair value gaps are holding very clearly. Perfect. You have a good resume. All right. Now I want to look to trade that particular market. Now, this no fair value gap and the no fair value gap conditions, that goes hand in hand with the arguments as well. Because at this moment in time, can we clearly get to a one-sided argument for the market? And the way I want you to see arguments is I want you to see one bullish person right there arguing with a bearish person that is sitting on the right there. And those people both have their own arguments, and we are just simply the observer of those arguments. And this one says, well, I have created a bullish or bearish fair value gap right there, because it's a bearish person. And the bullish person says, well, I have created a bullish fair value gap right there. So then that overall, if we take everything into account on what we're seeing on the chart, the fair value gaps, the candle signs, that leads to overall arguments, confluences, also known as confluences. And if we can get to a clear argument for one side, so one side right here, the bullish person might be the winner right there. And the bearish person loses the overall argument because the bullish arguments are just simply said stronger in the market. So that leads to then an understanding, okay, well, the bullish arguments are really strong, so I want to look at bullish prices. Where right here, if we go over that argument, we see, well, we have a bullish fair value gap right there. We also had a bearish fair value gap right there, which did not hold right there. Okay, bullish candle signs and bullish fair value gap, I would argue, is quite nice. But if we take a look at the previous price action, we don't have any signs of fair value gaps holding. If we take a look at the weekly, do we have a clear objective right here? We failed to take out that low right there. We also previously failed out to take out those highs, failed to trade even into that fair value gap right there. On the monthly, we failed to even create a bullish or bearish month fair value gap on the monthly time frame right here. We're not trading into the previous month's low, previous month's high. So the arguments are not very strong to trade towards one side of the market. So if you're ever struggling with the drawn liquidity, with the direction, create an argument. Create an argument between a bullish and a bearish person right there. And that will become more clear if there's a clear argument for one side of the market, that argument will likely win as well. And that is high probability versus low probability. Now, once we move on from that 50-50 price action, and this 50-50 price action is again the middle, but no fair value gaps can also be 80-20, right? Arguments can also be 80-20. And what I mean by that is still low probability conditions, right? What we mentioned in the beginning as well. That's still not high probability conditions. So the arguments and the fair value gaps should always be 100-1. It should always be very clear that one side of the market is winning right there. Moving on towards high probability conditions. So what then are high probability conditions? Well, it's the exact opposite of what we just went over. So if we do not have those low probability conditions, then most likely we have high probability conditions. Where the first thing is fair value gaps and fair value gaps holding. So the thing we went over right there, fair value gaps and fair value gaps holding. And the second thing is no trapped order flow. So we already moved out of that stage. Now, before we move on, let's actually see how we can recognize that we are moving out of that trapped order flow as well. So how do we know that we are moving out of trapped order flow? This big gray box you're seeing right there is a monthly fair value gap. This gray box right there is a daily fair value gap, and we even have a weekly fair value gap sitting right there as well. I'm going to use the daily right here as example. Now, when we move out of trapped order flow is the understanding as well that we have in those PD rays, we always have a 2-candle rejection, right? So this is the 2-candle rejection right there. And we also have this 2-candle rejection right there. So which one do we actually want to trade towards? Where can we actually break out of that trapped order flow? That is when we trade above or below those 2-candle rejection. That is the ideal scenario on how we can confidently say we are moving out of that trapped order flow. Now, that is not all, because sometimes we might sweep one side because we're still in trapped order flow. So sometimes we might sweep, like we're seeing the lows right there, to then just come back to that trapped order flow as well. So what do we want to focus on right there? We want to focus on, ideally, on the time frame we are looking at, a fair value gap above the highs of the trapped order flow or below the lows of the trapped order flow right there on the 2-candle rejection time frame that we are actually looking at right there. So since we are looking at the daily fair value gap, which can continue higher right there, that is also the one we ideally want to look at right there. Now, does that mean we automatically continue higher? No, because we still need to monitor the overall sweep versus the run on liquidity, etc. That's still, of course, important. Then looking at the ES example, we had this daily fair value gap right there. We had this 15 minutes fair value gap going into it as well. Then we have those 2-candle rejection highs. So we have this high right there, and we have this low. And ideally, we want to, again, run the liquidity either on the highs or the lows with a fair value gap going below it, ideally exactly overlapping with the lows as well. So every time we now come below it, we are creating that new low right there, and we're constantly showing signs that we want to sweep it actually, where here is the exact same, where this high actually is also a 4-hour value gap, which we can then continue lower off of. So if we are constantly sweeping again, then that is still somewhat trapped. So we still need to be careful of that as well. We want to see a run on liquidity, not a sweep of liquidity. That is very important. Otherwise, we will just constantly trade back to 50% of the range right there, because that is where we create that balance right there. And that is, of course, not what we want to see. That is very important. And the third step is know or the least resistance. So what does that mean? When we look at the same example right here on ES that we looked at a little bit earlier, then right there, once we come into that 4-hour value gap, which we can potentially continue higher off of, at that moment in time, we have quite some resistance right there going against us. We want to make sure that the highest probability thing is when we have no resistance anymore. So for example, right here, we have this 5-minute value gap, 5-minute order block, which we can potentially continue higher off of. Now we also have this order block that we are running into right there. So we are seeing a retracement because we see resistance from the order block right there. Now, if the order block was very strong, we would have seen lower prices all the way. We wouldn't have even created that 5-minute fair value gap higher. So the 5-minute fair value gap higher can still actually look to continue higher. So in between this area right now, what is actually the next resistance that we had on the left side? Well, that is this swing high. So in this area, that is a no resistance run, where if we have no resistance anymore, we will run very fast. That is what we talked about in the previous episode, no man's land. And when we have that, that is ideally where we want to look to get involved. So that is where, how do we view that again? Well, right here on that 5-minute fair value gap, if we now go into the lower time frame, and this can be any time frame, right? And on the 1-minute time frame, what do we see? A fair value gap going higher, indicating that there is bullish intention right there, that 5-minute value gap actually wants to hold. So that is exactly what we can then look for our entry, where we will create, again, that no resistance run, where it happens very fast all of a sudden. Then we run the highs, and then again, same thing happens very fast all of a sudden. That is exactly what we want to look at. Then to give you a higher time frame example as well, because it goes both ways, is here on US dollar JPY. We see this order block sitting right there. And we also see this order block sitting right there, which we come into. Then we have two different examples. This right here is a huge rejection. Like we're seeing, we have a long wick at the top right there. So what can we expect? Well, the retracement is most likely already going to be deeper. So why is that important to understand? That is important to understand of how we want to determine to get involved eventually. Because we don't necessarily want to look at just simply this 4-hour value gap right there and that first candle to then expect, oh, well, let me just look at a 5-minute sharp turn and let me look at higher prices. No, that's not going to work. And that oftentimes is a huge mistake that I'm seeing quite a lot of times, is where when we have a train coming against us, we can't just simply expect that to hold that with our bare hands. It's the same. If we have a lot of momentum right here going against us, we can't simply expect that if we have 4-hour momentum going against us, that the 5-minute time frame, a 5-minute sharp turn, will magically be strong enough to push price higher. It doesn't work that way. So that is extremely important to understand, that if there's a lot of momentum going against us, we also need to show, and we need to again show ourselves, and we need to prove ourselves that we also have a lot of momentum going for us again. So we need to wait for more confirmation. That is very important. And that is similar, but this right here is different, where I would argue we have less momentum, less long wicks like that going against us. A retracement like this, where we have resistance still, but a retracement like this is perfect, where a retracement almost does not need to happen, but it happens anyway. And when that is the case, that is extremely high probability to only look for example, a 5-minute sharp turn, because then you don't have a lot of momentum going against you for that 5-minute sharp turn to all of a sudden magically hold right there. And that is extremely important to understand. Where again, we went over this as well. If we have price action like this and a retracement coincidentally happens right there, that is what we are looking for to ideally get involved as soon as possible. But if we see that a retracement is coming our way and it's visually very clear that a retracement is coming, that's not necessarily where we want to ideally get involved as fast as possible, because then you will get sharp turns that will just fill like this and will fill, and then the more confirmation will eventually hold. But if you already take two losing trades right there, and then you take the winner eventually, and you risk or you target a 1 to 2 RR, then you will be a break-even trader. Now let's say you take 3 losses before you take the next winner, you will be a losing trader. So that might seem very obvious, but oftentimes people forget that we don't want to take a loss before we take the next winner, ideally, because that allows us to be profitable. So then again, it all comes back to filtering out the losses. It is not, and the way I want you to see this eventually is when you go watch my forecast eventually, you'll be here longer in the mentorship, you will see how extremely picky I am about my price action. And that is for a reason, because I do not want to take a loss before I take the next winner. Because if I take enough losses before I take the next winner, I am going to become unprofitable. So again, that's extremely obvious, but oftentimes people forget that it's not a utopia. The market is not a utopia. You have quite a lot of variables going into a single trade. Where what I mean by that is, if I tell a certain individual, doesn't matter who, right? And I can completely understand that. If I tell individuals, well, if you trade this 4-hour value gap right there, you can look for a 15-minute ST. That's a general rule of thumb, and that's extremely general. That is general as in that is under really good conditions that you can look for only a 15-minute sharp turn. But oftentimes you are going to need to require more confirmation in order for you to not take that loss. I cannot, and you can probably hear it in my voice as well, getting very, very emotional almost about it, where this is so extremely important to understand, where oftentimes sharp turns, ST plus reads, eventually entry confirmations, they will fail because you're not requiring high probability conditions of the higher time frame. Entry patterns on the lower time frame will always be there no matter what happens. They will always be there. There will always be some kind of entry confirmation. But where is the good entry confirmation? Because now we need to take into account, we're going to use a stop loss. So our entry needs to be quite accurate, and it needs to actually be when price is ready to run higher. And price is ready to run higher if the higher time frame right here agrees with the idea. I cannot emphasize enough on this. This is so extremely important because that is why most losses happen as well. Most losses happen is because you can probably see it if you scroll through YouTube comments or whatever it may be. Then you see, hey Arjo, you mentioned 4 hour fair value gap, 15-minute sharp turn, but here it does not work. And then if I look at the actual trade, it's trades like this, where you have a train of momentum coming against you. Do you really expect a 15-minute sharp turn right there to just magically stop that train? That doesn't make any sense. It's like putting a mouse in front of a train and expecting, hey, little mouse, you are going to stop that train, right? No, I'm not. No, we need something stronger. So we need more confirmation. Again, I can't emphasize on this enough. You can probably hear how passionate I am about this specific topic as well. So then the next point is, and the fourth one right there is again the opposite of what we talked about in low probability conditions. It's a clear argument winner. And the reason why this is so important, again, we ideally want to be 100% convinced that the probabilities are in our favor. Everything we do in the market is based on probabilities. So that means that we're always looking to do the highest probability thing. If we don't do that, then we are simply gambling. If we are 50-50, then we might as well go to the casino, right? We always want to make sure that we are doing the highest probability thing. So there's always a high probability for that thing to play out. Now, the reason that's important, again, because that will increase our win rate by a lot. And when we have a clear argument winner, so the market is 100% showing bullish signs, perfect. That's exactly what we would want to see, a clear argument winner. So let's actually look at that as well. All right here we have this daily fair value gap right there, which we can continue lower off of on the dollar. And we've actually gone over this price action as well a little bit. And we actually showed it in previous examples as well with the day, for example, the day that we can continue lower. Now, right here, we saw that CPI day on the Tuesday. So we had news day, we can continue lower off of that. After that, we create now a very suspicious price action. And why is that? Because at this moment in time, at the moment of that candle close, we are now potentially showing a sweep of liquidity. So again, the reason why I retrace those steps on the difference between a sweep versus a run on liquidity, how we can potentially see that very early, is because if we create this, all of a sudden, the bullish person right here has added another argument into the mix. So now, when that bullish person says that and says, hey, I'm sweeping that low right there and I definitely want to continue higher. And the bearish person says, well, I right here want to continue lower still off of this bearish value gap. Then I'm like, you both have pretty good points. But I would argue at this moment in time that if we do want to retrace immediately back into this 4-hour value gap, then this is suddenly, the bullish person is screaming into my ear again. But if we retrace into that bearish person's fair value gap, which he mentions, or she mentions, we can continue lower off of, then what does that create? A sweep of liquidity. So then I'm like, we can continue lower off of that. We can continue higher off that sweep. That is not a clear argument winner. There is no clear argument winner in that moment in time. So that is extremely important to understand that this is exactly price action where you would want to have more confirmation as well. And that is oftentimes what it all leads back to, more confirmation. So if we take a look at this price action right here, and we take a look at the previous week actually, we have this low that we could potentially target. And if we take a look at this big red box, then that is a monthly fair value gap. So off of that monthly fair value gap right there, we see that we have a long wick at the top. Perfect. We have a long wick at the top. We are not creating a bullish fair value gap coming into that. All right, that's quite nice. So overall, the first target could as well be that previous month's low right there. Okay, that's very interesting actually. So here, there are almost no bullish arguments. We have 2 up candles. Okay, that's it. There is no bullish argument here. So on the weekly, if we take a look at that, weekly fair value gap right there is failing to actually follow through. It is not continuing higher. The overall rejection is failing right there. Perfect. So what can we do? Well, right here on the daily, we see right now we are respecting that premium array. There are so many bearish arguments right here to be made. There's a clear one-sided winner. There is almost no bullish argument to be made right here, other than we are not creating a daily value gap lower. That's it. But other than that, we constantly have 4-hour value gaps going lower right there. We create that 4-hour value gap, and even after that, we run this low right there. We do not sweep it. We can then look to target this previous month's low. It's constantly the same thing over and over and over and over. It's the bearish arguments are simply winning, and that is a clear argument winner. So understanding the conditions is probably the most, I would argue it is actually the most important thing in our trading. Understanding the conditions, because I can teach you the fair value gaps and how they work. I can teach you the order flow, but if you do not understand the right conditions that you need to apply them in, nothing is going to work. So it's always going to be a losing trade if you do not understand the right conditions as well. It's extremely important, and that's why I'm so extremely picky about my trades as well, which you will see later on. Now, right here, we again want to practice. So first things first, study which instruments and areas are lower probability. So for this example, if you're doing this live, what I would advise is go over previous price action that we had throughout the previous week. Find again all the things we've gone over thus far and see why it doesn't play out, or see why it doesn't work at that moment in time. And then study the difference between why certain areas do play out and why other areas do not play out. So study the high probability conditions versus the low probability delivery right there. What is the difference between those deliveries? Where low probability conditions, oftentimes we will retrace back into a 50-50 area where we will just consolidate for a long time right there. The high probability conditions just take off. So you can go over any pairs, any instruments you want to for the previous week, and you can apply this study as well. And afterwards, we move on to the next week. All right, perfect. Thank you.